Good good evening, traders. Welcome to the Sunday Open. I'm your host, Craig Shapiro, macro strategist here at NinjaTrader Live. We have a great panel for you this evening to kick off December trading, the race for year end. So joining me this evening, I got Blake, we got Pax, we have Sara. How's everybody doing on this fine Sunday evening after Thanksgiving?
I'm doing awesome. I'm back in town and back in 85-degree weather. So that is nice.
I'm awesome too. I missed two of my kids went back to college today, so missed them. But it was great to be with four of my five children all weekend long, and my sister-in-law and her family, digging ourselves out of the snowstorm we've had this weekend.
Yeah, and I'm shipping my youngest back to Mississippi to Ole Miss this evening, and I'm at least 5 pounds heavier this week.
Yeah, yeah.
Me too.
You know, all right. Now that you mentioned that, Blake, yesterday I worked out, and I thought in the pictures on Thanksgiving, I thought, should I look like I've lost a few libs. I stepped on a scale yesterday. I was 6 pounds heavier. I was so disappointed.
Well, look, I joined you, but I avoided the scale. I joined you at the gym. I avoided the scale because I didn't even want to know. Not even worth knowing.
It's funny you said that.
Well, we'll get into all that. Futures just opened here. Thankfully, the CME found their cooling issue has been rectified, and we're going to be able to have futures trading this evening. But just to kick it off, looks like minis are up a scratch, two handles. Nasdaq up about 25. Russell is about a little flat. Bonds a touch softer. The big movers, silver up another 53 basis points to 57.55. Gold up about 10, 11 bucks. Dollar mixed, a little bit stronger. So kind of a quiet open after a big week last week. Vol selling, light volumes, thin trading, indices recovered all what was lost from the prior week and the NVIDIA news and then some. And so it'll be very interesting now that we're here in December. We got a ton to talk about, a ton coming up with the data this week. ISM tomorrow, ADP later this week. No non-farm payrolls this week, but we do have a lead up into the Fed meeting next week, which we'll get into. Treasury auctions, nothing going on this week. Potential Supreme Court ruling on tariffs tomorrow. Some people are thinking it's possible, 10% chance, more likely maybe the following week or the week after that. So just got to keep that in case that does come out. That would be something that would hit kind of late morning, would have some implications. We can discuss that further, but no, quiet open here after a big week last week. Want to kick it over to Sara, go through kind of how you're thinking about this week, what happened last week, how are your charts looking for across the major indices here?
All right, let's do it. So the first thing I want to talk about is we have a new month starting like right now. So that's important to us. It can bring new continuity and new all-time highs. And I do want to talk a lot about what happened last week, because last week, if you were on the stream, we were talking about last month's lows and that being kind of the line in the sand if you're going to be bullish or bearish. And you can only be bearish if we were below last month's lows. And if we weren't below last month's lows, you needed to be long, is what we were talking about. And it's really cool because they're making a broadening formation, and in the strat, all we talk about is broadening formations. We love them. So they took out these lows from back here on October 6th. We took them out last week.
Sara, what price are those? Can you talk about the price?
65.40.
Yes.
So we took out 65.40 pivot low. On ES, we took out the major pivot low on NQ at 24,158. And then what happened was on, I think it was Monday. Yeah, on Monday, we got what we call simultaneous reversals across the whole market. So that was the line in the sand, this little pink line. So like we were talking about, you can't be short unless we're below that. And we got bullish reversals up on Monday, which kept going and ended up triggering a reversal week on all of the futures. So the entire market, along with most of the sectors, reversed. So it was just a long all week last week. And now, since we've got all these monthly hammer type candles, that's what we're going to be keeping an eye on. So for ES, we want to be bullish above last month's highs. Well, we're bullish now, but we'll have a higher time frame actionable signal when we break these monthly hammers, or if we break the monthly hammers. And that level for PAX is 69.0950 on ES. NQ, it's a bit higher, 26.266. Looks like RTY is closest to triggering its monthly hammer at 25.08. And then YM is kind of a completely different story. But for now, let's see.
YM sucks.
I know you hate it.
No open interest, no volume.
We haven't broke Friday's high on ES yet. We did on NQ. NQ is the only one that broke so far above Friday's high. So we're looking to keep continuing up basically to the all-time high. That's what we kind of see for this week. I would not hate a pullback, some corrective activity on the daily, and then trigger the monthly level. So something like, little pullback here and then trigger the month and hit a new all-time high. PAX, there's your level, 69.80.
That's where we're going.
It says Uncle PAX level. And then your NQ level, 27.250. And then let's go talk about gold and silver, because those are even more fun. But you can see like the broadening here. I do hand doodle these all the time. Ooh, it's even bigger here. So you got a high, a low, a new high, a new low, a new high, a new low. So we're trying to come and make a new high. So that is, that's the goal. That's why we're looking up at all-time highs again. Let's look at oil. And oil right now is stuck still. We are currently a double inside month. I will show you the monthly chart. So the pink lines, that's last month's high, that's last month's low, completely inside the previous month's candle. So we're opening a current double inside month. Potentially what's setting up right now, if we break above last week's high and stay above it, we could trigger the inside month to the upside, in which case the first target would be up there at 62.59. I still want these levels at some point, but it doesn't look like it's going to happen this week, and that's fine. You just have to know what we're looking at and which way they're breaking. So looks like oil might have a bit of a bullish week. Gold. We were talking last week on the Sunday stream, if we broke above the previous week's highs, that was target 1, which we did hit, you can see, which was 42.50, and it's still attempting to go back to the all-time highs. We also have an inside month and up setup, but same thing, kind of line in the sand. You have to be above 42.63 to be long in order to hit the new all-time high, right? Because if you're not above this, you're not getting there, like plain and simple. So you have to be above last month's highs to get to new all-time highs. But the weekly entry last week was just perfect. So even if you're already in, you're fine. If you have a stop somewhere around like 40.35, like a little bit above break even or slightly higher, you're good to go. Because that was the Strat entry. And we also had a domino trade where we had a daily entry to trigger the week. So technically 4101 was the daily entry into the weekly entry to hit the target. And it did do that. So that's nice. Silver is an animal.
When you guys get to the target, Sarah, do you flatten or do you look for extension?
Well, there's different ways you can do it. So me and my partner trade differently. I take most of my position off at target, and I'll leave a little bit for a runner. He will tend to take a smaller size off and leave most of it as a runner. And me, I just like my plan. Like, so for this trade, enter here, target here, but the way you can trail it is as long as you still have higher lows on the daily, you're good to be trailing. So maybe even the 12-hour since it's futures. Yeah, let's do that. So you can trail on the 12-hour. You know, if you're trailing like loosely, and there was an entry, an ad right there, that inside 12-hour and up. But yeah, so you could still be in it, and this is above your target, so that's even better, right? You're locking in a little bit more, maybe even the 4-hour. If you wanted to trail super tight, you could. Just all kinds of ways to do it. With the strat, we don't do extensions. We just say it's still good. It's still going up. So until it reverses, you can be in it long. So until we break a previous day's low, which it doesn't look like we're going to today because we went to the upside. I seriously doubt we're going to go outside day. So that's the only way you would have to get out if we went outside day today or tomorrow.
So last week was it surprised me. And trying to think back just from a narrative perspective, like what was the driver? How did we have risk assets largely up across the board? Was there something out? You know, we didn't hear anything really from the Fed. We didn't hear anything from the Treasury. We didn't hear anything in way of earnings. It just seemed like we had a vol selling week after being elevated into the prior weekend post the NVIDIA stuff. And with holiday volumes being thin, vol selling was rampant, and the magnitude of the risk on moves all week just kind of, I mean, surprised me. We've taken, we did some damage to charts in the prior week. Packs, we had closed below, I think, your quarterly pivots, and then we exploded higher. I mean, was that kick it over to you, but just surprising. In hindsight, price is the price, but to have really not much of a narrative behind it, just had me scratching my head a little bit. Curious how you were thinking about it.
We talked about it. We talked about it last Sunday, I thought, pretty well. We had done some damage, and we had two closes below that those quarterly pivots in the S&P NASDAQ, 6658 and 24,568 respectively. But Monday, once we reclaimed those levels, and we held the as Sara was just showing us, we held the previous month's low, 65.20, 65.40, 65.89, depending on what you're looking at, depending on what chart you're looking at, and we held those levels, and we started to get back above, that 66.58 level. That's when it became a buy. Anything between there was the market looking for direction. Anything between those lows and 66.58 is the market, or the NASDAQ, is the market looking for its next move, either lower or higher. When Monday, we reclaimed that level, and we never looked back the rest of the week. Going into the end of the month with the capital flows pushing us higher, as they did, then later on in the week, Friday specifically became more about the metals, and silver, extending higher and really exploding higher for whatever reason you want to believe, some, CME going down because of some sort of a conspiracy theory, or the fact that, they just went down, regardless, silver was breaking out anyway, and the fact that we are trading in the 53 handle, and now in the 57 handle is indicative of the fact that there are more buyers than there are sellers. And I don't want to hear any kind of nonsense. Everything is rigged. Yeah, okay. If it's rigged, it's rigged. I don't care. If there's an open, to close, a high and a low, I can make money in it. I'm not going to try to figure out what in the hell is going on. All I have to do is trade my process and make money. That's it. So anyway, and Cooper just pointed out in the chat that the gold silver gold ratio broke out of a 4-year downtrend last week, and that's super bullish for both metals, which we have talked about in here the last few weeks too. Sara, you pointed out last week that I forget what low you had, but if it held, then we're going to rally back up to all-time highs, and I pointed out a close above 41.46 in gold targets all-time highs back up to that level, Craig, that we had discussed many times, 44 even. And, we get above 44 even. All of you guys who feel like you missed the gold trade, there's a lot more upside in gold. There's above 44 even, there's another $1,000, so just be prepared for whatever these markets are going to do. Gold can Silver can rally up to 80, 90, $100 an ounce. Yeah, I mean, you believe in conspiracy theories and gold, silver has been, artificially repressed for, low these many years. Okay, well, then that means that there's just more upside to it. Who knows? Trade what's in front of you. Trade the market as it is, not as you think or want it to be, and you'll be okay.
Pax, can I jump in there real quick?
Please, Blake.
You guys talked a lot about, you were asking about Friday. I think a lot of it was, you had end of month flows that were just going through the market. You had no liquidity. You had precious metals breaking out. Every bank report earlier in the week was all of them were written like let's say a week and a half ago. They're all looking for dollar selling or dollar buying, but that was on the heels of the equity markets being weak. So when the equity markets turned around, and Sara pointed out they turned around from some pretty key levels last week, then what was supposed to be dollar buying ended up being dollar selling. And when there's no one in the markets, it's like a domino effect in the markets. You see silver breaking out. Everybody looks at the dollar. They're like, well, hell, I'm going to sell some dollars right now. Then you got the Aussie ripping. Then everybody looks at the Aussie ripping saying, well, if that's ripping, that means the S&P should be going up and we should probably be buying some Bitcoin too. And when there's just lack of liquidity, you're right. You just got to take in what the price action the market's giving you at that moment and just kind of go with it. And Friday was purely a momentum trade across all asset classes.
100%, Blake. And listen, as you know, I talked about this last week too. I love that. I love that Friday trade. I love Black Friday's trade. I love it because of that reason. Lack of liquidity. The markets will move, and when they move, there's going to be a lot of follow through and a lot of flow behind it. We didn't see it in the S&P. We didn't see it in the NASDAQ. We saw it in gold and silver, especially silver. When I was trading in the NASDAQ pit, it was my first $100,000 day was the day after Thanksgiving. And it only grew from there. Most big traders weren't in there. I was in there. I sucked up the liquidity and the market ran. Well, it was silver market that ran, and for all those reasons, that's it. Trade what's in front of you. That was really well said.
It's interesting. Last year at this time, I was actually in California. My son was playing a college showcase in San Diego, and I was watching price action from my mobile phone, trying to catch the games and everything else. We had the same type of liquidity issues the day after Thanksgiving, the day before Thanksgiving in the FX market. And we almost had the identical price action this year where you just saw the dollar come unglued. Now, the problem is, as we go into, and I'm sure, Craig, you're going to be talking about this, especially what's happening this next week, all the economic data that we're going to be faced with, minus the non-farm payroll that we're not going to get until December 19th, or I think that's the day that we're actually going to get, which is after the Fed. Everybody's going to be preparing for the Fed. And now, when like I tend to trade FX markets. That's like my wheelhouse. When the pendulum swings too far in one direction, which they did happen to do on Friday, and then we're in a pretty critical week going in this next week with all the different ISM data, challenger jobs numbers, the weekly unemployment claims, which actually be recent. Anyway, we start getting some of this data. You're probably going to see that pendulum swing a little bit as everybody gets neutral ahead of what's going to be a pretty important Fed meeting in a week and a half, in my opinion.
Yeah, I think that this is digestion week, maybe digestion week coming up, right? Position squaring, position cleaning up. You had maybe you had the JV team in last week, in a holiday thin week, but now, varsity squad is back up. But you're right. I mean, we really have a couple of weeks left of trading, maybe, 2.5, 3 weeks left of trading this year before people pack it up again for the holiday. But such an important Fed meeting next week, where now the odds of a cut are, well above 50%. I think, 2 weeks ago, we were down closer to 30%. Now we're up above 80% again. So, it seems like we are going to get that cut. The question will be, is it a dovish cut? Is it a hawkish cut? How does Powell signal it? How does he placate the hawks on the Fed? And people will want to understand better as we transition into the second half of the month and into next year. Is the Fed really providing going to be providing that additional accommodation early in 2026, or are we going to have to wait until the new Fed chair gets in there? I think part of last week's trade also was, the rumors about Kevin Hassett being picked as the next Fed chair. His odds have certainly moved higher. And he is seen certainly as a more of a Trump guy, more of a shill for the administration. And so we saw a little bit more dollar weakness on back of that, some long end selling towards the tail end of the week, and broadly equities higher, Bitcoin higher. So that's the message that we're getting on Hassett. The announcement's probably going to be coming before the end of the year too, so that's something to keep in mind. But I think Blake, you got it nailed there on the FX stuff. Just probably more of a consolidation, range bound week here as people are preparing for that meeting.
Yeah, can I jump in here real quick and just mention something about Bitcoin? I know this kind of briefly mentioned what about where Bitcoin's at. One of the things that I tend to look at correlations, not because correlations correlations are nice for me from a should I be pressing my positions or not? If I have one asset class moving and another one's kind of confirming it, usually makes me feel a little bit better about being in that trade. If equity markets are selling off and I happen to be short S&Ps and I see Bitcoin falling, I feel more comfortable. Let's just put it like that. But what I've noticed anyway, is Bitcoin led the charge lower, and we had this really nice bounce in equities, as you guys been talking about. But Bitcoin's really lagged, and it's really still sitting below some pretty key levels here. And Sarah, I know we got your charts up, and I love how you look at the charts, because you're obviously a very skilled technician. If you go on like more of an intraday chart, like a 4-hour, you'll notice we're in a bear flag pattern, and we're flagging. Like if you can kind of zoom, you can squish that in and zoom out a little bit. You'll notice that we're just kind of at the it's flagging. All it is, and it just looks vulnerable, and it's not rallying with all other asset classes. Yes, we bounced a little bit, but for Bitcoin, I would think Bitcoin would be trading well above 100,000 right now, and it's not.
Yeah,
and that's got to worry me.
Oh, that's great.
Yeah, Bitcoin's the last functioning smoke alarm, right? It's the only market that's really not controlled by the Treasury, the Fed, or any other central bank. It trades 24/7, and you're right. I think it's indicative of liquidity being a little bit more strained than people realize. A little bit more of a risk-off flavor in some of these tertiary markets and some of these highly speculative areas, not just Bitcoin, but some of the altcoins and meme coins. And charts look a fair bit worse than that too. So I agree. I think last week just the recovery made sense with the vol selling, but the magnitude of the recovery in equity seemed overwhelming versus some of the other stuff that I think is going on. And without a real rationale or narrative or reasoning behind it, my sense is we're going to see a little bit of digestion and maybe a check back this week as people start to think about setting up for year end and maybe setting up again for 2026. We talked before about this idea that, and Anthony's talked about this, just about tech kind of holding in likely into the end of the year. Trends that are in place typically don't reverse in November, in December. And so the likelihood of tech continuing to outperform through end of the year makes sense. But then come January, people who are holding off from selling, who don't want to pay taxes in 2025, look to come in 2026 and maybe sell some of those winners. And so we may get some of that rotation or selling to start the year. So we got to keep an eye on that. But yeah, this week just kind of seems like very important from a data perspective, and giving some idea about trading for the entirety of the month.
Craig, that goes into exactly what we talked about when we met in New York. It's and going back to that level in the S&P that Sarah was talking about, the Uncle Pack slide. 6980 is the target in the S&P, and I never changed that target. We still target there. And then come the first of the year, I think we can start to see some real nice tradable vol, and not necessarily a break to be bought, depending on, of course, a million factors. But that is exactly what it looks like is going to happen. Will it happen? I don't know. I didn't expect I didn't quite expect the break in 2022 from 4808 to 3502. Yeah, and sure as shit didn't expect a rally in 2021 or 2020 from 2074 to 3756. I didn't expect any of that shit, and we got it, and it was tradable, and I focused on what the market was doing in front of me, not what I thought it should be doing and what I hoped it would be doing.
Yeah, you gotta really segregate those two ideas. I think I learned that the most, probably over the last, I don't know, I guess since the financial crisis, since the GFC. People tend to get so biased that it gets in the way of their trading. It's interesting, Pax. You point out that level, which would basically be a brief new high in the S&P. I've been tracking this this channel we've been in the S&P since 2018, and even getting up to new highs. You're going to be hitting the upper end of that channel. And from an Elliot Wave point of view, I still think we've either carved out the top of Wave 5 or we have one final high. So that would actually make sense if we actually made one final new high into 7,000 before you see a more substantial pullback. Rather than the garden variety, 5 to 8%, maybe seeing something more like a 10% correction in the beginning of the year.
Right, right, Blake. I mean, that's what we see. That's what I see too. That's what Craig and I were talking about.
Okay, all right, yeah, I like it. Yeah, I'm with you. And the thing is you got a lot of seasonality behind you, as you guys were pointing out a minute ago. Craig, you were just talking about it too. It's going to be really tough to really get this market to reverse lower. And I think the only thing that's standing in front of the market is in a week and a half when the Fed meets. And they may cut rates, but if it is a hawkish cut, the problem, and Craig, maybe you can jump in here and comment on this. If the Fed actually, cuts, but it's a hawkish cut, the fear the market's going to have is that whatever they've priced in for rate cuts going into 2026 might have to be pushed back a bit, because you think about Fed cycle, they're not known to cut and then pause, then cut again, and then pause. It's gonna if they pause, or it's hawkish enough where the market thinks they're gonna pause, it could be for a couple of meetings or more. What do you think?
Yeah, no, I think that's exactly right. I mean, it kind of, some people have been talking about, an analog back to December of 2018, where, the Fed kind of came in, towards the end of the year with more hawkish than expected, behavior, right? Just basically talking about the balance sheet being on cruise control, or I forget exactly what the terminology was. And markets really were reeling at that point and sold off into the end of the year on back of that. But I think there is a contingent on the Fed right now, led by regional bank presidents. Where regional bank President Schmidt has already dissented. He's likely to dissent again to a rate cut if that's what winds up happening. And there's several other regional bank presidents who are thinking that inflation is not on any particularly sustainable path down to 2%. Financial conditions are incredibly loose, and the labor market, although slowing, is not cratering here. And without really any good data because of the shutdown that we had, and we're not going to likely to get a catch up on data until really after the January meeting, there are several voters who would argue for no cut here. And if we do cut, they're going to need to be placated in some way by Chairman Powell if he agrees to a cut. And one way to do that would be signaling in the press conference or through the dot plot that the likelihood of a continuation of cuts for 2026 is being pushed back. And I do agree. I think that is a concern that markets would have if that's the reality, right? And so, Powell will be the chairman through the April meeting. So he'll have 3 more meetings next year. Then the new guy comes in for the June meeting. So if people start to believe that it's possible the Fed is on hold until the new guy comes in June, that's going to be a particular concern, for the market. So we'll have to hear from Powell on the press conference how he thinks about it. I mean, without the data, it just becomes hard to signal that this economy needs such a robust pace of easing, right? We know the lower part of the K-shaped economy is struggling, but the upper part continues to do incredibly well. The AI CapEx story is incredibly strong. Wealthy people are doing incredibly well, the wealth effect. And so consumption has broadly been fine. And to the extent that the Fed is going to be cutting rates, it's just going to lead to an exacerbation of that wealth effect, those wealth gains. And so, what is the Fed really trying to accomplish here by bringing down the front end by another 25 basis points if if financial conditions remain incredibly loose?
Yeah, that's great point. I mean, I don't know where you guys live, but where I live, I see more McLarens on the road than anything else. Not just that's a little bit of a joke, but seriously, I mean, it's like the rich, the K-shaped economy is going well. The trickle down effect isn't really trickling, but they're still spending.
100% right.
Yeah,
still spending.
Well, we're about a half hour in here. Time's flying. The biggest mover right now is, it looks like, is oil, right? So oil's up about 1.5%, and we talked a little bit about that. I mean, there's, this idea that the administration is, looking at Venezuela as an area to, I don't exactly know what we're trying to do there, but certainly some concerns of military action in Venezuela, which obviously has big implications for the oil market. Similarly, the Russia-Ukraine stuff, although peace talks have been top of mind, Russia continues to bombard Kyiv with bombs nearly every night. So it's not exactly clear that things are moving in a copacetic direction there. The inflation has remained largely not under wraps, but hasn't accelerated to the upside because the oil market has remained incredibly contained. And so to see oil up 1.5%, there was OPEC discussion over the weekend about bringing capacity online in a more, let's say, more guarded way. If oil were to move, and we've been talking about oil on the morning show for some weeks now, just as an ancillary beneficiary to the AI build out for power for next year. But if oil finds a floor and starts to rally back, and we start to bring back inflation concerns in the beginning part of 2026, the Fed rate cuts early in the year are not going to happen. The market's going to become incredibly concerned about that. I don't know, Blake, if you have any thoughts here on the oil market, but
well, first of all, I think it's like huge support. I know Tracy, Shy Girl, she talks about it a lot, and the only way that I see crude breaking through 50 or 55 rather is that we need to start seeing some really, really recessionary type of data, not only in the U.S. but globally. So unless that's coming our way, and U.S. exceptionalism is kind of shot in the head and dead, I just don't see crude really breaking down, and especially with, as you pointed out, all the risks that are surrounding around Venezuela and geopolitical risks just as a whole. Now, the question that I have, and I always have this, not necessarily at current levels, is at what level does it really start to spark inflation pressures or inflationary fears, excuse me. And usually that's not till we get into the like current levels, until we get up into the 70s or so. So I don't think it's much of a issue for the market. However, if we traded back above 60, I think it's going to get a little bit of attention for sure.
I think the level on the upside that we need to pay attention for inflationary purposes would be $77. Anything above that is going to be bad.
Okay, so that's where it kind of changes over, and so I'll pull up crude over here just to kind of see, and this is the level. Like I said, I think this is really important for the market. This is such huge support down here.
Yes,
and I don't see it breaking. Now, if it does, that's gonna send the market reeling. And like I said, I think we'd have to see some pretty deflationary pressures. Real quick, do you mind if I never mind. I'm not. I'm still showing the charts. Let me go over here and show this S&P chart, and I wanted to show PAX. This is what I was talking about at that long-term channel from like 2018. I don't know if you guys are looking at it the same way.
I can see it.
Yeah, that's the. See, this wave count that I've had it listed as 5 for the last couple months. I know we're in the vicinity where I just need to be very careful. That's why I have it up there. It's kind of like it's flashing warning to me. Not saying that I can't be bullish. That we can't hit new highs. It's just somewhere up here. I think it is a bit of a concern considering we're at 161% extension of wave 4, which you can see right here. And that was when earlier this year when we had our Liberation Day, if you will. So we're at the 161% extension or just shy of it. But as you can see, my calculations based on this CFD comes in just above 7,000. So that really coincides with PAX what you're talking about as far as a brief new high to your level.
Geez, that starts at from the lows of 2018 at 2346.
Yeah, that channel. Yes.
Yes. Oh, that's beautiful.
And
Now,
the lows are perfect too. My trend line needs to be adjusted every time I mess around with it.
Holy
But you can see
smoke.
it's almost to the tick, and to the pip, if you like to call it. And then there's the resistance there, so you can see it's pretty much perfection. And that's why I get really concerned up at these levels. Doesn't mean I want to short, but that's when I start looking at things like I know I was just talking to you guys about Bitcoin. And here's that flag pattern that the way I'm viewing it. Let me just pull it up really quick. And I'll just go on an intraday chart. Here's a 4-hour chart. You can see we're just sitting on flag support right now. Matter of fact, I had an alarm that just went off a moment ago because we're breaking through flag support right now, which again is another warning. This if you look at just match the S&P up to this, and you will see last week when Bitcoin was in free fall, it was really just kind of leading everything down, and the S&P turned first. Bitcoin it's kind of like Bitcoin turned because it had to, like everybody was like, okay, well, I guess risk isn't selling off anymore. It's time to cover up Bitcoin shorts. But as you can see, the move has been less than exaggerated, and it's really underperforming the S&P.
yeah. Just a quick look here at futures. We've turned red for the moment. S&Ps are down 5 handles. NASDAQ down about 5 handles. Russell down 5 handles. Gold and silver still firm. Gold's up $3, 42.58. Silver up another 50 cents to 57.65. Bonds are a little bit soft. I'm curious. Maybe we could talk a little bit about bonds here. Had rallied last week, and then towards the tail end of the week, kind of, didn't really break out with risk. Started to sell off towards the end of the week, maybe with some of the Hassett news. Maybe it's some hedging ahead of the Supreme Court stuff, which could come as early as tomorrow. We'll see. But Pax, how are you thinking about the long end here? I know you typically use that as a guide, something to keep an eye on here. But these UBs are 120.22 and ZBs are 117.07. Down 7-8 ticks to start the week.
Oh man, silver had not silver. I'm sorry. Bonds had a big hold at the quarterly pivot at 116.25 last week, and when it started to trade back above that, then you have to be long the long end. The level that needs to be taken out are going to be the highs of the month, which is 117.30, 117.31. And we take that out, then we really. We should really rally up to 119.06 at least, which is going to be close to the highs of October. 119.09 to 119.19. So we've got another couple of points in it, but the fact that it's kind of back below those lows on the reopen, and the fact that I completely agree with you guys, is that we're not going to do much in the indices this week. We're going to digest, we're going to churn. And I mean, maybe just grind a little bit lower, a little bit higher. Sara wants to see a little bit of a pullback to start the week to sustain a rally later on. I think that the bonds are going to sit in this range too, between 116, 116.25, 117.30. Anything between that is going to be, just going to be a back and forth trade. I really do think that the interesting story of the week is going to be silver. With gold, crude now is starting to look a lot more interesting, and I want to see what Bitcoin's going to do. The Bitcoin on a bear flag on a 4-hour is not especially bullish for these lows. The last week's lows,
right,
80,750, right? And I mean that's going to be the story of the week.
Yeah. Could you imagine if Bitcoin takes out that 75,000 level? I mean that would be I mean it would crush everybody.
Yeah.
I mean I constantly think of Tom Lee and his exposure in Ethereum, and I'm like, my head just
huge stops underneath there.
I mean, there's been such a huge narrative shift with Bitcoin. We've been talking about it, on the morning show. Just, this idea of store value, limited supply, play on government fiat debasement, government deficits. That's the reason to own it. So, have a small allocation to it. It's grown 50% a year for 12 plus years, whatever the story is. And then what's gone on lately is it's become, tied up in the casino market, right? And you have all these digital asset treasury companies like MicroStrategy and others that are just levering up their balance sheets to buy Bitcoin. And so you have a much more leveraged structure, new players, new entrants coming into the fold. And anytime you get leverage into an asset class, as the cost of capital moves higher, we start to get this deleveraging. And I think part of the story on cost of capital rising has been this AI CapEx build out story, right? And we've been talking about this for the last couple months as the build out has become increasingly debt financed. Oracle, Meta, Google, Amazon have all hit the investment grade debt markets over the course of the last 1 to 2 months. It's starting to crowd out leverage and borrowing everywhere else in the economy. And so cost of capital is moving up for everybody else. And that includes these levered Bitcoin entities, right? And so I think we're starting to see some of the unwind of those levered positions. And so it's a little bit of a last in, first out dynamic here. Some of these late institutions and treasury companies that have bought in are showing the showing the exits here. And so yeah, it looks technically it doesn't look great. And the narrative is shifted too. And so even though the administration is clearly in support of crypto and Bitcoin, the markets are acting the other way here.
You just said something so interesting,
Yes,
Craig, and something
you
I've
did.
been last in, first out. Think about that concept, and I don't think people take that into account enough. Let's just say you're an asset manager and you got 200 billion under management, and you're late-ish to the crypto game. You bought into the idea that, oh, it's woven into the fabric of Wall Street. I'm going to buy Bitcoin. I'm going to buy Ethereum, and I'm going to allocate like, 1.5%, 2% of my funds into Bitcoin. I mean, when you're looking at gold perched up above 4,000, you look at silver breaking out, and you own Bitcoin and Ethereum and some other meme coins for the same type of reason. I'm sure you're looking at your portfolio saying, why do I even own that? Like, I'm just going to stick with what's tried and true and tested over the years.
Yes.
Let's get rid of the Bitcoin. Let's get rid of the Ethereum, and let's keep silver. Let's actually add to that position. Let's add to gold.
Yes.
Do you think that's what's happening? Because I do. I think that's exactly what's happening.
Yeah, I mean, look, I think when you bring in institutional ownership and institutional sponsorship, you get institutional type risk management philosophies, right?
Yes,
and so
right.
this is not just the hodl philosophy. It's not just buy and hold forever and suffer, through historical 75, 80% drawdowns and come out better the other side. These are institutions that have mandates and have P&Ls and have their own business risks. And so I think, for anyone who kind of got in over the course of the last, let's say 12 to 18 months and had been sitting on gains in Bitcoin, bought it well, you're selling some, right? And anybody who's late to the party here, you're not really advocating adding to exposures at this point because the story is a little bit murky. The truth of the matter is the deficit expansion story in the U.S. has actually hit a bit of a speed bump this year. The deficit has actually come in lower than expected because of the tariff revenues. And so if your thesis was government fiat debasement and deficit spending forever, well, there's a little bit of a hiccup there. So I agree. As you bring in the institutions, volatility in the asset class has come down, but that also brings in that kind of institutional trading mentality. And so, things that haven't really worked, get them off the sheets before the end of the year. I think we're seeing some of that dynamic as well amidst a larger multi-year broader story about shifting some of your store of value allocations into Bitcoin, but there's really no rush right now as the technicals are struggling. I think that's definitely part of what's going on here.
I know I mentioned it a little bit earlier, but his face is like you look at Ethereum and you think Tom Lee because that's all he's got this big. I forget what his big
Bitmine,
is.
I think, yeah,
Bitmine, yeah. I mean, institutional adoption in Ethereum and the stories. I mean, were all when Ethereum was trading above 4,200. So I have it highlighted up here, and I just think about everybody that owns it in that just said, "Oh yeah, I'm buying into that story." That was like literally 40% ago. You know what I mean? It's 35% ago. Sorry, we've had a bit of a recovery, but. We've seen, a north of 30% drawdown in those assets. I mean, I like it when, and you guys know this as traders, because this is how I feel as a trader. I love it when the market gets wrong-footed, because that's when I just start pressing,
Mm-hmm.
because I know that they're wrong. And when they're wrong, I just like to pile on top of it like anybody else. And so I think a lot of these institutions are wrong-footed in these crypto names.
Yeah.
So, anyway.
I want to just for a moment, I want to just jump back to silver and this CME closure last week. I mean, Pax, you've been around the CME for a long time. You know the players there. I mean, to see the futures exchange closed for that period of time, how as a trader in the moment with positions, unable to execute, unable to do anything about it, that's one thing. But then even thinking about this going forward, allocating to your risk capital and thinking about just exposures. I mean, does it affect you at all? Just, that the exchange shuts down for 10 hours and nothing can happen. I mean, for all you guys, just did it affect you? Will it affect you? Will you think about position sizing differently amidst this kind of, I don't know, a little bit of a out of left field, almost like a black swan type of event where the exchange just decided to, close for an extended period of time?
One of the great things about CME in my entire life is going back to like 1987, when New York, after the crash of 87, New York Stock Exchange did not open for a number of days. Leo Malamed had worked with the banks in Chicago to make sure that their books were reconciled, and CME was open the next day so that the world had someplace to hedge their risk. So when we fast forward to, the only times that I remember being shut down for a number of days was during 9/11. We were shut down for, I think, a week or close to it, business week, and had and reopened, and it was mayhem after that. The world didn't know how to price. We didn't know where to price things. When we were the Nasdaq still the Nasdaq still the volume in the Nasdaq was still in the pit. The open interest in the Nasdaq was still in the pit. So it was wild and crazy trading. Our margins were raised to I think it was like $200,000 a one lot. It was unbelievably crazy. So, when we fast forward to something like this, I'm not going to size differently in my silver trades. I'm long silver and I'm staying long silver. But if I have an intraday position on, I will think twice about making sure I'm hedged, making sure I have some options against it, that I've got something to look at that can protect my downside in the event of another outage. And the reason I say that is because I have a huge amount of confidence in CME. Maybe I'm just speaking because that's where I grew up. I literally grew up on the floor. I grew up there, and I developed. I met my wife there. I developed my entire career there. I know Terry Duffy very well, and some of the people that still run the exchange, many of them. But I will the way that the way that the power grid is set up, and the way that these I'm going to talk about shit I don't really understand. The way that everything is starting to happen with the data centers that are being built, and all of these things are going to completely strain the way that the power grid is set up, and the way that we pay for our power, receive our power, and how is that going to affect the data centers for the major exchanges? I don't know. I don't know what I'm talking about, so I don't know. I would have felt more comfortable if CME did not completely shut down the floor in 2020, and that there were still a few people standing in a pit where, we could have gone to, in the event of prolonged outages, that there would still be a physical place for us to go and manage these risks. So I don't know, man. I don't know.
Yeah, look, I think one of the areas where I know there was some concern was in just the zero data expiry options markets, inability to use futures to hedge overnight, and then just kind of watching the opening pricing. Bid asks were incredibly wide for the first 15, 30 minutes, maybe even longer. And I remember there was an issue about 2 months ago where the options pricing reporting authority, OPRA, had some issues pricing options, to the markets for like 45 minutes to an hour. And so, I don't know, just something to keep in the back of folks' minds, as markets become much more options driven, options focused, particularly in S&Ps and in futures, and in index futures, just how important options have become and how important zero data expiry options are, that when we get these weird hiccups, whether they're exchange closes or, option reporting data that's comes in, improperly. It's another one of those left tail risks that people just have to kind of keep in the back of their mind when things are going incredibly well or poorly, whatever for that may be. Just, something out there, black swan type things could happen.
Yeah, and they will
just
happen.
to kind of keep in your mind, and will happen. Yeah.
It will happen. There is no doubt that every single one of us need to be protected in every way, shape, and form. Look, I have like four keyboards. If this breaks or I break it, more likely, yeah, you son of a bitch. I've got 4 more of them. I've got extra screens. I have 2 laptops. I have backups for backups for backups. And that's just on the physical stuff for my trading, let alone, my positions. I don't always hedge my stuff, and I don't always have I always have my downside protected with stops. I always have my downside protected in other ways. But this really made me think about, what is the best way that I can protect against an outage? I can protect against a black swan event. I can protect against some major conspiracy theory coming through, an EMP being blown up, and now what? Physical gold, you don't own gold and silver unless you have it in your physical, physical possession of it, and maybe not in your house, but certainly someplace accessible. Am I hedged enough with enough physical gold, enough physical silver? How can I hedge myself in options a little bit better? There's just a lot of things that we all have to really pay attention to in this very uncertain world.
Yeah, no, for sure. Well, we're coming up. It's 650. Just another look at futures here. S&P 68.52 down 7 handles. Nasdaq down 12 to 25,470. Russell down 7. Dollar a little bit stronger. Gold and silver continue to be better. Silver up now 70 cents to 57.86. Oil better, up 1.5% to 59.45, and the bonds are a little bit weaker. So, but largely a quiet open on the calendar for this week. As we mentioned, tomorrow we get the first of the month, so you get those 401k inflows coming in, new money, new month. The first day of the month is typically, lately has been pretty good for indices, but we'll see. We do have some data tomorrow. We get the ISM data tomorrow. Chairman Powell does speak tomorrow night, but we are in a blackout period, so highly, highly unlikely he will say anything that has to do with anything regarding monetary policy. It would be very unusual if he did do something, but we'll keep an eye on that. And then on Wednesday is the ADP data, which without the non-farm payrolls report coming until after the Fed meeting, people will be looking at the ADP data as a potential signal for strength in the labor market. Now, we have been getting weekly ADP payroll releases, and last week's was pretty bad. It's showing negative momentum there through the last 4 weeks of through the middle of November. So the potential for a negative payroll print in the month of November is high. And then Thursday we will get the claims data, and Friday we get the core PCE data, but that is for the month of September. So highly, highly stale data coming from that. And as far as any other data is concerned, nothing really. I mentioned the Supreme Court stuff, but probably won't happen. Probably won't happen tomorrow. But if it did, I think that would have some implications for the bond market. If we start to hear about the administration losing those tariff revenues and the budget deficits moving back out again, that would be something to keep in mind. But with 5 minutes to go here, maybe we'll just go around the horn. Sara, just top idea or top thought for the coming week, anything you're particularly focused on or looking to execute on?
I really just kind of want to see if we can get simultaneous breaks on the futures for the monthly triggers. I'll go, so if we can break above last month's highs on all of them, that would be very bullish for us. And then continuing to watch gold and silver as they're the strongest. It looks like silver's the strongest. And then gold still has room to its all-time high. So kind of just watching everything. Well, at least those 6 things.
Yeah. Sarah, do you have a copper chart by any chance? Someone's asking about copper. I don't really. I mean, copper has been kind of really driven more by the administration's trade policy, and so it had been good. And then they changed the tariff policy in the end of August. We had a big move lower. I mean, I think the fundamental medium to longer term story on the grid build out and the power needs in the US are highly, highly bullish for the copper market, but you have to get through what remains to be a very elevated inventory position. And so while the longer term dynamics for copper market are good, short term, there's a lot of supply on exchange in the US that really, needs to get worked through. And so all these AI capex build out plans, which are going to be bullish as the grid gets built out, that just takes time. And the other big driver for copper is, Chinese property market, which remains mired in slowdown. And so, it's a harder trade. It's a different trade than gold and silver has been. But I think broadly, as you're thinking out, 12 to 18 months, we need a lot of copper, and mine supply growth has not really kept pace with the expectations for future demand. So constructive medium to long term, but have to get through some of this inventory stuff. And I mean, the charts are, it's kind of been range bound here now for the last 3 months or so. And
copper is the Russell of the metal.
Yeah, I was just gonna say that.
Yeah,
so I think this is a fugly chart, and why trade this chart when you have gold and silver doing what they're doing?
Right.
This is just stuck. I mean, it's trying to go back up, but it's just slow, like really slow going, and there's just better things to trade.
Sarah, a lot of people they don't look close enough at what's happening in platinum either. Platinum's doing the catch up from I don't know how long you guys have been married to your significant others, but I bought a platinum ring for my wife like 25 years ago, and I'm like, maybe I should have bought gold, but now it's playing a little catch up here.
That's hilarious. It's a great point. I did the same thing.
Yeah, we just took out a level, like platinum hasn't hit levels this high since 2013. Like it just now hit. Or sorry, 2013. So that was what, 12, almost 13 years ago. So, but it's looking like it's going to keep going up.
Yeah, it's like, as you pointed out, some charts look fugly, some look a lot better than others. So
yeah. That's what's so good about trading. We can trade whatever we find, like attractive, or that's a good chart that's not stuck, that's moving. We don't have to trade copper or cotton or pigs or whatever.
Yeah. Pax, any final thoughts here as we wrap up for the hour?
No, I think the indices just kind of churn, a little bit this week. And it'll be interesting to see. It really is. I would love to have bought the breakout on silver, but I didn't. I was sleeping. But I'm looking for a place to buy more silver and gold. I'm glad that I bought some gold last week, and it's going to continue up. 44 even is the next upside target in gold. So keep your eye on that. And above that, we've got just a ton of upside. So I don't know. I'm looking forward to seeing what happens in the metals. Crude, I would have liked to have seen some place in the 55 handle to get long. I had some resting bids in there. I didn't buy anything in the 57 handle, 58. I think we can target up to 60.50 and then 61.80 in crude on the upside. And then, above that, who knows where we go. So I don't know. It's going to be a good, rollover. I wanted to mention, somebody had asked earlier about rollover in the indices, and that starts technically the second week of December. But just look at December 10th through December 15th when we get into FOMC time. We get into the Fed meeting. That is going to bring some. Whenever we get into rollover, will bring some volatility. The week to 2 weeks before it usually kind of sit. So I'm expecting a sitting market the next couple of weeks with some rollover volatility coming in, and then we'll trade up to 69.80, and then we'll see what happens at the beginning of the year. So don't sleep on the month of December. It's going to be a busy month. It's just not going to be this week.
Yeah, it's interesting that the Fed meeting is next Wednesday, which will be kind of, and then the roll kicks off, and then
Yeah.
options expiry is the following week. You know,
Following week, right.
we've seen historically the Fed meetings kind of coincide with the options expiry week, but this month it's actually
earlier?
it's actually the week before. It's just you know kind of a little bit of a different dynamic for you know for traders to think about. But Blake, last word here. Anything?
You know, as you guys have been talking about, or we've been talking about, the pendulum swung a little far last week, and I think it's going to be a digestion or consolidation week. But in currencies, because that's my wheelhouse. I'm actually buying dollars down here because I think the dollar's at risk of a break higher, especially if we get a hawkish cut. We get a hawkish cut, the dollar is going to rip, and I think you have every bank in the world targeting the euro at 125, and I think that's an appropriate target. I just don't know if it's a near-term target, and I think a lot of people would be wrong-footed if the euro sees 114 or below. So I'm personally buying dollars here, and in the event we get a hawkish cut next week, then I think I'll be sitting pretty if you're long dollars this week.
Yep. All right. Well, we're at 7 o'clock here. Thanks everyone for joining us. Everyone have a great week. Don't forget to like and subscribe to the channel, and join us tomorrow morning at 8 o'clock, where myself and Deli and Tracy will be there for the morning gap, and we are excited to kick off the run for the end of the year here. So thanks again for everyone joining us, and have a great evening.
Have a
Bye,
great week,
everybody.
everybody.
Bye-bye.